Here is a comprehensive data-driven TLDR, summarizing the key dynamics, asset levels, and macro trends from the Global Market Intelligence Report. Hashtag 1. The Big Narrative. The Warsh Trade and Geopolitical Crossroads. The Warsh Trade. The Senate confirmation of Kevin Warsh as the next Federal Reserve Chairman has triggered a major repricing of global assets. Markets are actively pricing in an aggressive, structural contraction of the Fed's balance sheet, quantitative tightening, to levels of monetary restraint not seen since before the Great Financial Crisis. This is systematically draining shadow banking liquidity, creating a powerful risk-off gravity pull. Geopolitical shock absorber. The ongoing U.S.-Iran conflict has severely strained global energy networks via the blockade of the Strait of Hormuz. However, optimism surrounding diplomatic back-channel peace talks has temporarily deflated the war premium, dragging crude prices down. Hashtag 2. Forex and currency crosses. U.S. Dollar Index, DXY. The greenback is exceptionally strong, trading near 98.98 to 99.24, and challenging key resistance at 99.40 to 99.50. Long positioning has surged, with asset managers expanding their net long DXY contracts to a 15-month high. Euro-USD, hit by severe stagflationary headwinds and a technical death cross. The Eurozone growth forecast has been downgraded to 0.9%, while inflation expectations have been lifted to 3.0%. Euro-USD is trading around 1.1643 with a bearish trajectory. GBP-USD completely reversed after a fakeout at the 1.36 major resistance level. The pair is hovering near 1.3487, with asset managers building their net short sterling positioning to a 10-week high. USD-JPY. The yen remains highly vulnerable near 158.80. A messy Bank of Japan tightening cycle and domestic fiscal spending anxieties have driven asset managers' yen gross shorts to a 22-month high of 108.4K contracts. Commodity pairs AUD and ZD CAD. AUD-USD is trading near 0.7170, supported by a hawkish Reserve Bank of Australia, RBA, but capped by broader USD strength. NZD-USD sits near a 3-week low around 0.5875 on domestic economic fragility. USD CAD resides near 1.3797, heavily exposed to daily oil price fluctuations. Hashtag 3. Commodities and hard assets. Crude oil, Brent and WTI. Global benchmarks tumbled over 4.5% in late May 2026. Brent dropped below the psychological $100 mark to trade near $97.80 per barrel, while WTI slipped to $92.88 per barrel on U.S.-Iran ceasefire hopes. Physical markets remain extremely tight with rapidly declining global stockpiles. Gold XAU-USD, decoupled from rising real yields to hold firmly above $4,500 per ounce, currently near $4,560 per ounce. Relentless price-agnostic central bank accumulation, 800 tons annually, for de-dollarization is keeping a hard floor under the metal. Copper HG. Copper is defying traditional recession signals, trading at $6.39 per pound. Massive structural supply shortages in copper concentrates are colliding with inelastic demand, driven by global grid electrification and AI data center buildouts. Hashtag 4. Digital assets and crypto dynamics. Bitcoin BTC. Experiencing severe technical exhaustion, BTC has slid to $76,846. Weakening spot ETF flows, with over $1 billion in net weekly outflows in mid-May, and negative perpetual funding rates, show that leverage-driven futures are dominating price action over spot demand. Bitcoin dominance, BTCD, has breached the 60% milestone for the first time in 2026. This reflects an aggressive flight to quality inside the digital asset space, starving altcoins of liquidity. Ecosystem outliers. While major altcoins languish, artificial intelligence AI tokens like Near Protocol Near and Grass have surged by over 18%, driven by NVIDIA-fueled retail speculation. Hashtag 5. Central Bank and Policy Watch. The Fed, newly sworn-in Chairman Kevin Warsh is expected to aggressively prioritize balance sheet reduction over interest rate cuts. Markets are currently whispering zero rate cuts for 2026. The ECB, paralyzed in a stagflation trap, the Governing Council has kept rates steady as the Middle East conflict pushes Eurozone inflation to 3.0% and heading higher, while crushing domestic manufacturing growth. The RBA handled a hawkish surprise by executing its third consecutive 25 bps rate hike to 4.35% in May. This was triggered by a fuel-driven headline CPI spike to 4.6%. Hashtag 6. Geopolitical risks and fixed income plumbing. The convexity doom loop. Surging U.S. 10-year Treasury yields, which recently peaked at 4.69% and settled near 4.56 to 4.57%, have triggered a negative convexity hedging frenzy. Holders of mortgage-backed securities, MBS, are being forced to aggressively dump Treasury futures to offset duration extension, exacerbating the broader bond market rout. VIX complacency. The S&P 500 Volatility Index, VIX, is trading in a highly suppressed range near 16.70, representing dangerous market complacency in the face of deep structural and geopolitical cracks.